Hello, everybody. My name is Bennett Tchaikovsky, and welcome. We're going to go through some intermediate accounting today, which is always fun and exciting. So, disclaimer and copyright notice is that the information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make reference to publicly available information that is the copyright of other parties. I do not claim any right to the copyright that I'm referencing in those parties. So let's take a look at our sample question, which is going to basically be subsequent events. So let's take a look at this here in Excel format. So we are the auditors for Lakewood Financial Services. The fiscal year ends December 31st, 2023, and the financial statements are scheduled to be issued on March 20th, 2024. During my final review in March, you discover the following, right? So we are the auditors, okay? So a long-standing customer with $900,000 in accounts receivable at December 31st, 2023, filed for Chapter 11 bankruptcy. Lakewood's attorneys have advised that they are presently unable to determine how much will be recovered. However, the amount will be less than the full balance. Okay, so let's look at each one of these separately and let's just kind of go through and answer each one of these questions. So this is going to be an example of a type 1 event. And why is this? Well, is it because we said a customer bankruptcy in our lecture parts? Partially, but it existed at year end. That receivable was around at year end. And therefore, and again, this kind of illustrates the importance of going through and running credit and background checks before we go through and deal with anybody. And so this is what we're going to refer to as a type 1 basically event. So for part A, we're going to call this type 1. Now, what would be the journal entry we would need to do? So this kind of brings up two different things. Now, if you're taking my class, I'm not going to actually make you do the journal entry, just because I think that that's for those of you who haven't had, well, it's just kind of mean. I don't know. Am I getting nicer in my old age? I don't really think so. But in any event, so if I know that an accounts receivable is not good, then what I have to go through and do is I have to basically record bad debt expense and then credit the allowance for doubtful accounts. Now, this is basically increasing. I would essentially look at my aging of accounts receivables and say, okay, the probability of this not being collected is extremely high. But again, it's Chapter 11. We don't know. We just know it's going to be less than the full amount. By the way, just a side note, you can buy insurance to prevent something like this from happening, and the insurance will basically pay you out. So you can get insurance for everything. So I can either debit bad debt expense and credit the allowance for accounts, or I could write it off by debiting the allowance for doubtful accounts and then crediting the receivable itself. So I could do one of these two. However, if my auditors, if I'm specifically writing something off, the auditors are going to go through and more than likely and rightfully say is like, okay, Bennett, like what else did you not record correctly? And they would be going through and saying that. Okay, and let's make this a little bit cleaner. We'll call this number 1. We'll call this number 2. We'll call this number 3. And we'll call this number 4. Okay, so for each type of event, describe the journal entry. So we got B, let's see below. Okay, and we'll do this with a nice color coding. There we go. And of course, I would want to put a journal entry description. I would want to put a date, put the amounts in, so it looks correct. But again, if you're taking my class, I'm not going to make you do that. So this is part 1, 2, and now part 3. Now, this is not applicable because this is not a type 2 event because this actually happened post year end. Now, where would I go through and basically what else would I go through and do here? Well, I would also probably disclose the write-off And there's one question that I forgot to go through and include in this. And let me just put that in right now, which is this. Okay, and this is, does the event trigger a potential Form 8K filing? You do not need to discuss the basically where it is, rather why this would basically be filed. Okay, so, and we'll talk about the auditor's responsibilities at the very end, but essentially, if management refuses to make the adjustment, then essentially the financial statements aren't truthful or accurate. So you have, oh, is this now going to be a qualified or adverse opinion? That's a whole nother discussion. But does this trigger a Form 8K filing? What it's going to depend upon is how material is this to the financial statements, right? So if it is in fact material to the financial statements, you would probably want to do some sort of a Form 8K filing. Again, as I mentioned about this in the prior video, an 8K filing is going through and being used for material events. Just give me a moment. And so here, like the different like categories for 8K filings, they go for a CEO quits or CEO, CFO leave. Again, Reg FD to make non-public information public. There's a variety of different things. However, with this one in particular, you would probably say, um, yeah, we would probably go through and say with this one, and I want to go refer back something. Just give me a moment. So this could basically be like an 8.01 other event. Again, it's just going to go through and depend, right? So if someone is, in fact, if you have a customer that is going bankrupt and investors know that in the financial statements that you have a significant balance with that customer, then you would want to go through and file an 8K basically for immediate disclosure. And you would also more than likely list this as a subsequent event that possibly there was a bankruptcy from one of the customers. And, again, you would want to kind of go through and discover it. But we're going to call this 8K maybe. And then the real question is if it's material. Okay. So let's go ahead now and take a look at the next one right over here, which is we signed a lease for a new corporate headquarters. A lease is material to the financial statements, but it was signed after the financial statement date, which was December 31st, 2023. So this is going to be type 2. Okay, not applicable because we're not going to adjust the financial statements. However, we are going to probably go through and talk about it maybe in the management discussion and analysis, plus as a subsequent event in the footnotes to the financial statements, was I was kind of showing you for the American Eagle Outfitters in my prior video. So again, I'm going back and referring to that video a lot, but that's probably going to give you the best, overview of what's happening. So that is right over here. Now, as the auditor, we'll talk a little bit about that at the very end. Does this trigger an 8K filing? And it's going to be basically, again, maybe. And I would probably say because the agreement is material, yes, because the amount is material. And this could be like a material contract. So that's really that's how you would more than likely describe this. So that's what I would go through and do. Okay. Now, a flood damaged equipment at Lakewood's main office, a loss of 1.5 million uninsured, right? We always want to get insurance, not at the blackjack table. You always want to get insurance, in the appropriate places. So right over here, because this happened on February 18th, remember our financial statements are basically dated 12/31/23. We're issuing our report on 3/20/24. This is kind of falling in the lines of, okay, this is 2/18/24. So this is going to be a type 2 event. And again, this is essentially because it did not exist at the time of the balance sheet. So this is going to be not applicable because it is not a type 1 event. Where would I put this? MD&A plus the subsequent event. And this is also going to be an AK if this is if a material loss, right? And remember, investors can like pick up on this information if they see that your company was reported in the local news that there was a flooding in there, and they're going to ask almost immediately is like, well, were you insured? What was the loss to production or whatever else may have you? So you're always on the better side of going through and disclosing. Remember, when you choose to become a publicly traded company, you're choosing just to open up everything to everyone. Okay. Now, a lawsuit that was filed against Lakewood in September 2023 existed prior to the balance sheet date, was settled for $600,000 on January 1st. This is going to be a type 1. And then over here, for this one, we'll create a new color, right? And we would probably say like lawsuit or expense. And then we basically would credit like accrued liabilities. Now, what's also going to depend too is that did we accrue for this previously? Like, is it probable, and can we, is it probable and can we reasonably estimate the amount? Like the whole contingency, the whole contingency part. Like, did we already accrue for this? Now, what over here would this basically, and this would also be discussed possibly in the MD&A, and this well as a subsequent event. Well, I would probably say it would be possibly you would say it's something like along the lines of the MD&A. Again, it would be a discussion. Again, you're going to the item of basically, and I apologize if I'm, kind of being, on both sides of the fence on this, but it really depends on facts and circumstances. And if it, again, if it's, would you go through and adjust it? I would probably say that yes, I would probably be basically putting this as like an update to the footnotes, especially if it was disclosed in somewhere in the litigation amounts. Now, would this be an AK? And again, it goes down to materiality. Yes, possibly material. Okay. We declared a cash dividend on March 1st. Okay, so this is happening after year end. Now, this is going to be type 2, not applicable because, again, there's no journal entry that is required. Now, would this be in the MD&A? Now, it depends on how does the company normally issue dividends? Is this an unusual dividend? It depends on the facts and circumstances. Is it a large amount for this particular company to be declaring a cash dividend of this amount? Is it, what's going on? So again, I would probably not necessarily do anything, but as far as like where would it be disclosed, you might actually see it in a press release. Because if you're declaring a dividend, you're going to want everybody to know about it because it's a good thing. Investors like it. And then over here, press release possible subsequent event. But again, it's going to depend upon, is this really normal? Is it unusual? Like what's going on that front? And then lastly, does it potentially trigger an AK filing? More than likely, it depends on the nature of the dividend, but more than likely it would essentially be like an announced more than like a press release. And if it is in fact in a press release, it would be simultaneously filing an 8K as well. Okay, so 8K. Okay. So government and regulators announced a new investigation into Lakewood's lending practices occurring prior to December 31st, 2023. So with this here, and just give me one moment, this is going to be type 1, okay? And what this is going to require the company to go through and do is the company is going to need to essentially go through and do an assessment, right? And what is that assessment? They're going to have to talk to their attorneys and they're going to have to do that. Well, is it if they announced a new investigation, but it's bogus? It's like, okay, you're probably going to have to definitely make some sort of an 8K statement because if the government announces an investigation from a PR perspective, if you as a company are not coming out and saying what you're doing to address it, that's not going to be a good thing. So if in fact, though, that there is merit to this and it is, probable that it's going to happen, remember the different categories, right? And it's like can estimate, cannot estimate, probable, reasonably possible, and remote. So for these ones over here, um, right, we don't do anything if it's remote, but if it's reasonably possible, right, this is going to trigger disclosure. And we've got a visitor. Oh yeah, always exciting to see you, Ozzy. So, unlike the candidate who's no longer running for, I don't know, who's that person running? Was it Porter? Yeah, Katie Porter, who like yells at her associates. I don't like to do that. I like to greet everybody. Yeah, Ozzy, want to come on up? Go say hello. Yeah, I think my viewers want to watch you. Like a kitten appearance is always amazing. So we're gonna have here disclosure. Honestly, in fact, I'm going to give you a platform to launch on. So I'm going to make this even easier for you to see our guess. Okay. So then over here, we've got probable, and this is what we can estimate it. And if it's probable, we're going to basically record it. So this would essentially be the situation we would have to go through and make this assessment. Right. Okay. We're going to take a little tap break. So we're going to stop the share. We're going to see. Okay, Ozzy, you want to say hello? Yes. Yes. Cap breaks are always good. Yeah. That's what makes, this Ozzy deserves to be like a YouTube star. He really, it's a great cat. Yeah, what else you want to say? Yeah. Let's give him his due. No. I don't think people want to see me. I think people want to see you. You're much more exciting. By the way, as soon as my son comes home, this cat completely ignores me. It's life. Okay, what else you want to do here? Yeah, what's going on? Okay, let's finish up this video. So we've got a good kitten break. Okay, so let's go back over here. Perfect. Okay. So right over here, and then so this is what's going to happen here, and then we're basically going to put this on an 8K. Now, as auditors, and I was kind of leaving this towards the very, very end, but essentially as auditors, what would we do if, management refuses to address any of these subsequent events. The first thing you're going to go ahead and do is document the disagreement in the work papers. Remember, these are management's financial statements. As an auditor, you're going through and giving an opinion. If it's a audit, if it's a review, it's a different level. But what you're also going to do is you're going to consult with the audit committee. It'd be good if I knew how to spell that word correctly. Basically over here, we're going to consult with the audit committee of the board of directors. And then I'm going to issue possibly a qualified or reverse audit opinion if that omission is in fact material. And then you're basically going to also potentially be resigning from the engagement. Now, in most of my experiences with audit, I've never had something like this happen. You have, discussions that are like fruitful and hopefully productive. But, again, this is why when you are working as an auditor, you have to be extremely careful with who you are choosing to take on as a client, because auditors typically have like the most amount of liability when it comes to, anything, in accounting. And I will always give this example when I talk to students about, and I think we've answered these questions, but I'll kind of end with this. Um, Whenever I talk to students about, okay, when you're going to go into your own business as a CPA, what should you do? And it's really funny. I used to say it was tax and bookkeeping, but one of my students who I interviewed on my YouTube channel said, "Oh no, Bennett, you either do tax or bookkeeping. You don't do both for the clients because that creates issues." But doing tax or bookkeeping engagements is significantly less risk than doing an audit. If you do audits in specifically of publicly traded companies, you are literally you have to have the resources and support to really make sure that you're doing that work effectively. And when you audit publicly traded companies, it just puts you at a whole nother level in terms of risk. So I usually try to, when you're auditing, and some people do it really, really well, they can do it at smaller firms. There's a smaller firm that is in Orange County that I know, some of the partners, and they audit pre-revenue biotech companies. And that's a very safe way because you're not looking at the same kind of like risk or exposure that you would essentially have if you were doing, revenue generating publicly traded companies. And so, in a lot of those clients that they eventually move on from them because a lot of these companies need to be with big four firms for investor purposes, ultimately, not immediately, but ultimately. So you end up like looking at these things and kind of saying, well, is auditing publicly traded companies a good thing? And again, I've seen more companies more often than not choosing effectively not to do it. So in any event, though, thank you for watching. I appreciate you liking the videos. I have no idea whether or not this helps. I always hear the creators who will say that, but I do appreciate you though, tuning in and watching this, as well as the best cat on the planet, which is going to apply to every single one of your own felines or puppies at home. But thank you so much. If you have any questions, please feel free to reach out to me at ibc30tocpa@gmail.com. I'll see you on the next video.